Hi, welcome back. It's Jason Labrum, Financial Detox and IDA Wealth with Alex Klingensmith, and we are on part 3 of debunking investment myths, helping you get financially detoxified and manage your wealth for greater impact. We went through a whole bunch of them. I'm not going to repeat them. Check out parts 1 and part 2 if you want to see several other debunking myths, but we're going to go ahead for this part and we're going to jump into a couple that I think you'll find interesting. Percentage gains and losses are equivalent. What does that mean? Higher levels of positive returns are required in order to fully counterbalance losses. Does that make any sense to you, Alex?
It does, only because one of my most humbling moments with a client was when the client taught me this early in my career. He's like, if I have $1 and it goes down by 50%, and then it goes back up by 50%, we're still not back to where we started. And I'm like, what are you talking about? And then he did the math on the whiteboard for me. And I'm like, I should understand that better.
Yeah, you go down 50, you have to go up 100. And it's real simple. If you have $1 and you lose 50%, you have 50 cents. For 50 cents to get back to $1, it has to double. It has to go up 100%. Now that number gets less significant if you only go down 25%. You only need to go up about 30 something. I don't have it right offhand, but to get back to even. So 100 and being down 50 and having to go up 100 is kind of the starting point, and you can decipher from there. But what's the point of that lesson is like, do we need to go get big gains? Not really. What we need to do are reduce the potential downsides. And the way to do that is by investing in a diversified portfolio. Right now, the NASDAQ is on fire. It has done phenomenal, not for 3 years or 1 year, but for 5, 10, and even 12, 15 years. Large cap growth has outperformed value, and the NASDAQ has been on fire. Everybody has forgot, or they didn't exist as an investor, that from 2000 to 2017, the NASDAQ was negative that whole time. If you owned the NASDAQ in 2008 and March or so of 2000, you were negative for 18 years before you got back to even. So that's, I think the story here is, if you buy the greatest, hottest thing and it has lots of potential upside, it can also have lots of downside. And it's probably better to think about diversification and think about making money by not losing money, right? If I never go down, I have a much higher likelihood of going up and creating. So there's a balance there where equities have higher returns than bonds, and private equity has higher returns than public equity. So by adding in asset classes that don't act like each other, they're non-correlated, you reduce the volatility, because when one is yinging, the other's yanging, and one's doing well while the other's not doing well. And that reduction of volatility is what can really help drive your returns going forward. It's an awesome phenomenon that you don't have to go knock the cover off the ball and hit home runs and have the most aggressive thing to actually do well. Gold is a big one. I mean, this is the time, right, Alex? Here's our next one, part 3, our second debunking myth. Gold is a safe haven. Although gold has traditionally been considered a safe haven, its recent risk-reward metrics suggest it may not always serve this role effectively. I love it that you used to hear, why don't you ever hear those commercials anymore, Alex, that like, buy gold in your IRA, get a gold IRA. Did they make that like illegal or something? Because you used to hear those, particularly when gold was up all the time. Anybody hear?
I hope it's because they got in trouble for misleading people, but I don't know for sure.
They must have, because they're all but gone. Or maybe I'm just not listening to the radio anymore.
That's part of it too.
The radio, it was mostly radio, I think.
Right. Do you hear them anymore, Brian? Shane, have you ever heard the gold commercials in the last little bit?
No, I haven't heard them or seen them. They used to do infomercials late at night too.
Oh yeah.
They're everywhere. Now it's crypto, man. Crypto's the new gold.
Right. Right. So how about 2012, looking at the S&P 500? And if you check back to our parts 1 and 2, you hear us talk about the S&P 500 as all US, all large cap, predominantly growth. Not a perfect proxy for a great diversified portfolio. However, it's what we have the most data on, so it's constantly used in our presentations and slides and understanding markets. But the S&P 500 had a return of 14.8%, while gold during that same time frame there on the top part of that chart, 6.3%. But the other thing is that I think you have to look at the standard deviation of gold. And for those of you who aren't aware, standard deviation is how we measure risk and volatility. So a high standard deviation is lots of volatility. A low standard deviation is low volatility. So the three parts of the markets we're looking at on the right is the stocks, large cap US stocks, the S&P 500, gold, and then bonds. The AG is the aggregate global bond or the aggregate US bond index. Look at the standard deviation of gold versus the standard deviation of stocks. Almost the same. Gold has experienced similar volatility to stocks. So is it really a safe haven? I think the data suggests it's probably not a safe haven. And it's also had a less return than stocks. Look at the ratios. 6% return to a standard deviation of more than double that. But you look at the annual return of the S&P 500 at 14 versus a standard deviation of barely more than that. Which asset class seems like a better long-term investment to you? To me, it's clearly the S&P 500. Bonds seem like the worst, right? With a 2% return and you're going out and getting 3 times that in a standard deviation. That's not a good exchange. It's a reason why owning equities, if you can stay put, stay invested and have patience and be a disciplined investor, you can make a lot more money over time, as history suggests. It's the 1-2 punch on part 3. We're going to come back with a final part 4 for debunking investment myths. Stay tuned. Alex and I will be right back on that. Give us a subscribe and a like. And thanks as always for tuning in to Financial Detox.